Welcome to Winning Retirement Television. My name is Cynthia DeFazio, joined today by Greg and Kristen Taylor of Legacy Retirement Group. And to our viewers at home, we're going to be talking about 3 retirement traps today. We've all been in situations where we have felt trapped. Well, we don't want you to feel like that during your retirement years, so we're going to tackle some of those traps today. Greg, how are you?
I'm doing great.
Good. It's so good to see you.
Good to be here.
Great. And Kristen, how are
I'm
you?
doing fabulous. How are you?
I am doing fantastic. Thank you so much for asking. I'm excited about today's show because people don't like to fall into traps of any kind. No one likes that feeling. Have you guys ever gone on one of those mazes where you have to find your way out?
Oh, my goodness.
Yes.
Oh my gosh, that's what this reminds me of today.
Anxiety, right?
Yes. Kind of like, where's the door?
Some of them are really good, and you're thinking, how am I going to get out of here? Or your kids, when your daughter was younger, didn't it make you nervous when she would go off without you, and you're thinking, how am I ever going to find her?
Yes,
Yeah.
It's the worst feeling, not at all. Well, we're going to dive right in. So, Greg, this first one I want to guide to you called the investment trap. What things do we need to watch for when it comes to the investment trap?
Well, you know, if you think about what it is to be trapped, typically you get lured in by something. You know, a mouse gets lured in by the cheese.
Yes.
You know, a bear gets lured in by something in a bear trap. We used to live on 6 acres, and we had moles that would burrow just under the surface, and you would see these little mounds all over the yard, going all over. And so we would have to get the
Animal control,
and they would come and get them and safely take them off somewhere else. I'm not quite sure where moles go when they take them away, but
it's supposed to be humane.
Exactly.
Probably released into the forest.
Exactly. So they can make all the little mounds they want to make. But the same thing can happen with investing. So with investing, you get lured in sometimes by fear.
Makes sense.
A lot of people go to these dinner seminars, and it's typically someone that's selling insurance. And at those dinner seminars, they try to make us afraid of the stock market in many cases. And that fear sometimes causes people to make poor decisions, and they're more conservative perhaps than what they should be over the long length of their lifetime. They need that money to grow and keep pace with inflation. And many times they get put into products that they feel trapped in because maybe there's a high surrender charge to get out, or there's other things that make them feel like they're trapped in an investment. And there actually might be ways that they can get out of those things, but they need to know about them. They need to figure out, okay, how do I get out of this trap of fear?
Yes.
How do I make that better?
Yeah, and on the opposite side of the token from that would be greed.
Yes.
Greed is another big one. So I remember during COVID, you know, the pandemic, I should say.
Right.
When there were so many things going down and then things popped back up, right? Remember, quickly? And then there was these stocks. Now they call them meme stocks. I don't know if that was a tag phrase then, but there was these stocks that people would go in and jump in because they were doing incredibly well, incredibly fast.
Yes.
Now, that's okay to have a portion of your money in something, but the problem is a lot of people were taking and going all in. Like, you know, I've never actually played a table in Vegas, but I've watched people play, and they're throwing, you know, thousands of dollars down and going all in on one number.
Yeah.
And I think it's the same with the stock market. You have to be really, really careful. Like Greg said, you don't want to operate under fear, but you can go the other extreme and be too greedy and want too much gains that you know, put your entire nest egg at a detriment, especially if you're just going after one stock and not diversifying.
Yeah, another allurement is a shiny object, I like to call it.
You have shiny objects in your life that happen.
Like you?
That was actually kind of sweet, but I don't think you meant it.
Oh my goodness, but a shiny object can be when you see that commercial sometimes where they say, protect your IRA, put it all in gold.
Yes, yes.
Well, first of all, gold doesn't protect anything. Gold is a commodity. It goes up in value, it goes down in value. You can gain in gold, you can lose in gold.
True.
So that could be a shiny object. And I have people call quite regularly and they'll ask, what do you think about gold? And I think, well, it is an asset class and it's something certainly to consider, but you certainly shouldn't put all your money in an asset class like gold. Or when technology stocks are going really, really well. You know, and I won't name any individual one, but there's ones that become really popular. Everybody wants to jump in on them. In fact, we had a client call in and recently and said, you know, this stock's doing really, really well. should I take money out of my CDs and put it in this stock? I said, well, are you willing to lose money that you have in CDs? If you are, having some properly invested a portion in that stock might make sense. But if you're not wanting to lose that, if that's why you had it in a CD, then it may not make sense to invest in this stock. So you have to be really, really careful. Cryptocurrency is one that's gotten a lot of people where it's not that it's wrong to invest in it, but which one do you invest in and what's the right timing of it? And there's
what portion of your portfolio?
Exactly.
Yeah.
And here's the problem. When you invest in things and then it goes down, you feel trapped because you feel like, okay, I can't sell out of it now.
True.
Because I've lost too much. And that's a horrible feeling, to feel like you're invested in anything where you can't get out of it where it makes sense.
True.
And that's a tragedy. We don't want that to happen to anybody. That's why, one of the specific things that I believe is very, very important in investing is that you have a game plan for it. So in other words, what you invest in should be based on your plan.
Okay.
And your plan then determines how much you have in each piece of everything you have. And so it's all based on a risk score.
Okay.
It really is. So you can range that anywhere from 1 to 99. But if your comfort level between how much you can gain and how much you can lose is, say, a 50, but the portfolio you're in is a 75 or an 80, then what's going to happen is at some point that portfolio is going to do something that frightens you.
That makes sense.
That makes you uncomfortable.
Yeah.
And then you're going to feel trapped.
Greg,
Absolutely.
how many times do we run into families coming into our office that, they've been offered something like a product somewhere else and it's got some luring thing about it, an interest rate or a nuance to it that is just a shiny object?
Oh, for sure. I mean, think about it when I-bonds, when interest rates were still low and I-bonds offered for 6 months around 8 or 9%. And I would have people call, should I put money in I-bonds? I said, well, it's not necessarily bad to put money in those bonds, but realize that interest rate's only going to last for 6 months. And I-bonds aren't the easiest things. They're not impossible to get out of, but they're not easy to get out of. So more than likely, you'll keep your money there at whatever interest rate the government's willing to give you at that time.
Wow. Okay.
So not feeling trapped, Cynthia, to me, with your investments is a key. But most people have no idea how their investments are actually doing.
Yeah.
Peeling back the surface on those and understanding how your investments are actually doing. So what is my average rate of return over time? How much risk did I actually go through with that investment or these investments? How efficient are they? And something called alpha gives us our risk-adjusted return. How well did we do? If it's a negative alpha, you didn't do so well. You're not efficient enough. And there's other things, other metrics, just like when you go to the doctor and you have things tested, you find out, oh gosh, I thought I was perfectly healthy, but I might need to work on this, or I might need to work on that. I may need to take a medication, or I might need to eat a little healthier. Those are things that we can find out simply by having it tested for our health. Well, I think it's important to have the healthier portfolio tested as well.
Sure. So it's kind of like a portfolio x-ray, if you will, Greg.
Oh, for sure. It is kind of that, because when we do a portfolio x-ray, what we do is peel back the surface and look underneath to see where you stand. See if you are taking more risk than you're comfortable with. We don't want you to feel trapped. So if you would like to come in and take advantage of that portfolio x-ray, you're welcome to call 614-336-7660, that number that's on your screen. Or even easier is going to legacyretirementgroup.com, hit schedule now, and you can set up a time to meet with one of our fiduciaries.
Greg, thank you so much. Kristen, thank you so much to the viewers at home. That number to call for the portfolio x-ray is 614-336-7660. If you're in the viewing audience today and you don't know how much risk you're actually taking in your portfolio, this is the perfect opportunity for you to call in and to claim your spot for that x-ray today. Again, 614-336-7660, or if you don't have your pen handy, grab your smartphone. Click on that QR code at the bottom corner of your screen. That will take you right to Legacy Retirement Group's landing page, and you can schedule your time accordingly by using, is it Calendly?
Yes.
Calendly, perfect. You can use Calendly on your own to schedule a time that will work for you and that coordinates with Greg and the team. Again, the number 614-336-7660. We'll be right back after this very short commercial break, diving further into the next two retirement traps. Stay tuned.
Plan smart, retire well. How do you do that? Many times we meet families and they actually think they have a plan.
But what about when you want to upgrade your house? What about when your wife wants to buy new furniture?
No investment decision should be made outside the context of a plan. So what is your plan? We believe in the 3-bucket approach as it comes to your finances. Your liquid bucket, which is what I call the sleep well at night account, for when the what ifs happen in life. Your income bucket, which is there to meet the gap between Social Security, maybe a pension, and what you really want to live in. We believe you should protect that income, then grow the rest. And then your growth bucket. The growth bucket's really focusing on helping you achieve your growth goals. As you transition from your working career to retirement, we want that to be the greatest moment of your life, and we don't want you to fumble the ball.
So imagine, when you're working, you're getting a paycheck. When you're retired, you have to pay yourself. The 3-bucket approach is a really easy way for people to start compartmentalizing what they're doing with their money.
We want you to be successful in any economy. We want you to thrive no matter what's going on. Worry and fear and greed are the biggest problems when it comes to investing. We want to take that off the table, and we want to make sure you have a consistent growth strategy. We want you to be just as successful in your retirement plan as you were in your accumulation plan.
Welcome back to Winning Retirement Television. My name is Cynthia DeFazio, joined today by Greg and Kristen Taylor of Legacy Retirement Group, and we're talking about some common traps that people can fall into in retirement. We want you to avoid these traps. So this next one, Greg, I'm going to guide this to you. This is interesting to me. It's called the income trap. What is the income trap?
Well, absolutely. Just like the investment trap, when we get to the point where we feel stuck, then we feel trapped. And I'm thinking about a lovely couple we began to work with in the last 6 months. The husband's 75, the wife is 73, and they retired when the husband was 65. So been retired for 10 years. And when they retired, they had about $950,000 in their portfolio. And the broker they'd had for 20 plus years, they liked him. They trusted him, and certainly he said, we've done a pretty good job for you. You've averaged about 7% a year in your portfolio. So if you want to pull out, and by the way, they needed $36,000 a year. So he said, if you want to pull out 4% from your portfolio, that should be no problem. So they thought, well, that makes sense to us. And so that was their income plan, to pull 4% out of their portfolio. But after 10 years, that portfolio dropped to just over $500,000. And now they were starting to feel the pinch because they didn't feel as comfortable taking $36,000 a year out from $500,000 as they did almost having $1 million in their portfolio.
Wow.
So they came in for some help, and they realized, okay, there are some things they can do to protect income. Now, we couldn't quite get the income level that they wanted, but we were able to get them where they could reasonably be and feel like they were in control. That got them out of the trap.
Okay.
Well, and I think that's a perfect way to illustrate 2 different parts of the income trap. And one of them is having unrealistic income goals based on what you saved.
Okay.
Because as you start to really think through your retirement years and what you've set aside, what your nest egg is, and what you need, there's a lot of math involved in that. I think there's some budgeting that goes on. There's really some number crunching to figure out what makes sense for your situation. So many times our families, I think they will start into retirement with this big nest egg and just start taking money. Greg makes fun of me because I use the phrase willy-nilly all the time.
Yep.
But you just start taking money because there's plenty of money there, right? What could go wrong? And then the market drops, or we have a couple bad quarters where it's just flat, really overall. And people start to feel uncomfortable after they've kind of done whatever they wanted to do, instead of really having a plan in place in advance of taking those dollars out.
Okay.
So that part of it, but also having the wrong investments for income.
Yeah.
Don't
Correct.
you think, Greg?
For
You
sure.
can't get guaranteed income out of a non-guaranteed source. Of course you can, but it's not going to feel good when the market goes up and down, right?
True.
So it depends on your overall investment, your overall nest egg as to how you should be invested for what you're trying to accomplish with that income.
For sure. Well, that's what happened with this couple that I was talking about, because the thing that got them to where they were investing in the stock market to accumulate over a 20 plus year period it worked well during accumulation, what they didn't realize and what their broker didn't realize, because he doesn't focus only on retirement. The broker was a good person, by the way, and certainly meant well, and felt bad they'd lost nearly half their money. I mean, he felt really bad. So it wasn't like, okay, they had a bad advisor, just he didn't realize that money works differently when you're taking it out, and it's called sequence of return risk. And when you expose yourself to that and have the wrong investments for income, now that's a key, because everything in money has a benefit and an associated risk. So our money in the bank, the benefit is it's safe and liquid. The associated risk is inflation.
True.
The money that we have in brokerage accounts, stocks, bonds, mutual funds, and those types of things, they give us the most opportunity there is for growth over the long term. And for the most part, those assets are liquid as well. But the associated risk is we can lose our money. And then insurance products can give us growth and safety and lifetime income. The associated risk is liquidity risk. So everything has a good and a bad, but realizing what the best tool is for you in life, I think, is huge.
Well, and having a written plan for your income.
Yes.
That accounts for rise in prices like inflation. You mentioned the 4% rule, Greg, a little while ago. If you're drawing 4% out, but do we know the long-term inflation rate is 3.2% for long-term? So when we have a target of 2%, but inflation over time tends to be a lot higher than we realize it is. And guess what? That's just the percent. That's just the rate in which the percentage increases. That's not, prices don't go down once they go up.
You're right.
So we need to account for that when we set up our income plan and say, okay, there may be increase in prices. I need to adjust, and I need to have this written out so I know where the extra money is going to come from. And then I know I'm going to at least attempt to be okay as I move through my retirement years. But just pulling money out isn't a good plan. It's not a plan at all, actually.
No, it isn't. And the problem is, when you retire at 60 or 62 or 65, there's that air of excitement, I think, for many. They're excited about the new ventures that are getting ready to take place in their life. And
of course.
So they want to make sure that they can maintain that. And it's all based on income, because income is your lifestyle. That's how you pay your bills. That's how you take your vacations. That's how, spoil the grandkids and all the things that people tell us are important to them, or those that like to play golf. I mean, golf is not the cheapest sport in the world, so you have to have income in order to be able to do those things, your hobbies and all the things that fulfill you.
And you start that income plan right at the conference room table.
Oh, you do. But the problem is, what happens when you're 75 or 80 and now your income's falling? You need to make sure it's going to last.
Absolutely. Absolutely. Perfect time for us to take our second commercial break. Would you both agree?
Absolutely.
All right. To our viewers at home, the number to call is on your screen, 614-336-7660. If you don't have a written income plan for your retirement years, this is the perfect opportunity for you to call in and to claim that spot, to have that plan drawn up for your needs. Your goals, your desires, everything that you want for your retirement, Greg and Kristen and the team will be able to lay out what that plan will look like. But you have to do one thing. That's call in today, please, 614-336-7660. If you don't have a pen handy, you can grab your smartphone, click on that QR code. It's so easy. It'll take you right to the landing page for Legacy Retirement Group, and you can claim your spot accordingly. You can book your appointment by using Calendly, the easiest thing ever. Again, 614-336-7660 for your written income plan. We're going to take a very short commercial break. Don't go anywhere. We're talking all about some traps that people can fall into during retirement, and we want you to avoid these. Stay tuned.
For over 4 decades, the government has been telling us you can save for your retirement in tax-deferred accounts and take a tax deduction on your current income. They tell us no worries. When you retire, you'll be in a much lower tax bracket. You can then take withdrawals and save a boatload of money on taxes. We have been conditioned to pay the least amount of taxes today, assuming tax rates will be much lower when we retire. But let's be honest, with over $32 trillion in national debt, we have a tax bullseye on our backs. Take control of how steep your tax burden will be in retirement by taking the Roth Conversion Challenge. Provide us with your retirement account statements, and we will design a Roth conversion plan for you and your family to make your retirement income plan truly tax efficient. Enough is enough. Don't let the future legislation significantly increase your taxes during retirement. Take the Roth Conversion Challenge with us and remove the tax bullseye from your back. Go to testmyretirement.com or call to set up your no-cost, no fees, no obligation consultation. We look forward to seeing you at our office, and have a blessed day.
Welcome back to Winning Retirement TV. My name is Cynthia DeFazio, joined today by Greg and Kristen Taylor of Legacy Retirement Group, and we're talking about some common traps that people can fall into in their retirement years. This next one, Kristen, I want to talk to you about is the tax trap. How can we avoid falling into the tax trap? Because I think a lot of people are concerned about taxes.
Yes, they are, and we have 3 different types of tax categories, if you will. So you have taxable, you have tax deferred, and you have no tax, non-taxed. Okay, and so I think the biggest tax trap is that tax deferred. Because what do we all do? We follow the crowd, right?
Yes.
And we all like the 401ks. 401ks are great. It's free money, right?
Right.
You put money in, you might get 100% match. Who wouldn't take 100% increase on their money, right?
That's true.
Smart, do it. Everyone else does
Absolutely.
it. But there's something that a lot of people don't realize. A lot of people had the option of getting a Roth 401k and just didn't know. It wasn't communicated to them. And we'll talk about that in a little bit. But as you're moving towards retirement and maybe you are contributing to a 401k, it might be time to look and see if there's a Roth available so that you're not just continuing on that trap. And why do we call it a trap? So, would you buy something without knowing the price? That's exactly what we're doing with tax deferred dollars. Greg likes to say it all the time, and I love it. I'll steal it from him. An IRA is an IOU to the IRS.
Yes, she used something I say.
Great.
And I didn't mess it up.
No, it's perfect.
I mean, it's a really
Yes.
good saying, and it truly is, because we don't know what our future tax rates are going to be. We're putting this money aside so that we can save money now and not have to pay tax now. None of us like paying taxes, but we have to.
Right.
And so we do. But then we're kicking that can down the road. We're pushing it off for later, and we don't know what later's percent is going to be. We don't know how much we're going to have to pay on those dollars.
That's right. And we have 2 teenagers at our house. What do we warn the boys about all the time? Don't just follow the
That's
crowd.
it.
Because a lot of times
Absolutely.
when you follow the crowd,
That's
you
it.
make a bad decision.
Well,
That's true.
Well, Christian started driving not too long ago. Now we
Yes.
have Cameron driving, which is
I
crazy.
can't believe that.
Yes, 2 drivers in the house. And when Christian started driving, one of the first things I told him, I said, do not drive other kids in the car. You can have your brother in the car, maybe one other friend just to go to school, just a couple miles down the road, but that's it. No driving around town. And he said, well, Mom, everybody does that. Everybody drives with more than one person in the car. I said, yeah, but if you're the one that gets pulled over, you're the one that's going to get a ticket and a problem with your license. Because in
true.
Ohio, teenagers aren't supposed to drive with more than one kid in the car.
Okay.
And so we had to tell him, okay, it's okay that everyone else does it, but there's consequences to that action.
Absolutely.
Okay, potential consequences. And same is true with the tax deferred dollars.
Absolutely.
The potential consequence is you're going to pay way more than you would have paid if you just take care of the tax now.
For sure. So not only do we get trapped sometimes by following the crowd, but we get trapped sometimes by our tax preparers. Because what do tax preparers want to do? They want to be your hero today so they can justify what they're charging you to prepare your taxes.
That's true.
So as they're doing your taxes, a lot of times they'll say, why don't you go ahead and contribute the amount you contribute to an IRA or contribute more to your 401k right now because you're going to save X number of dollars of taxes today.
Yeah.
But that can multiply over multiply over multiply many times, and what that costs you later as those dollars grow and as tax rates potentially increase. So the tax preparer can help guide you into a trap, which is those tax deferred dollars. Also, we can get trapped by our desire for instant gratification, because who wouldn't want to save money on their taxes this year?
Of course.
I mean, and we all have a sense of instant gratification. You know, if I'm hungry for pizza, I don't want it in an hour and a half. I want it now.
That's right.
You know?
Quick delivery.
So I don't usually have it delivered to the house. I go get it because I'm not impatient enough to wait.
You're not patient enough.
Yes.
You said impatient.
That's true. All right. I stand corrected again. All right. So, and also, we get trapped by acting like the future will never come.
Yeah.
True. That is true.
So imagine, Cynthia, you work in real estate. Imagine one of your buyers sitting down with a loan officer, and the loan officer says, look, we know you're good for the money. We'll figure out a repayment plan later, and we'll tell you how much the interest is later. How many of your buyers are going to take that loan?
Bye.
Yes. See you later, right?
Exactly.
But all of us that have put money in traditional IRAs, all of us that have put money in 401ks or 403bs or deferred compensation plans or TSPs, we've taken that loan because we're putting money in at today's tax rates and getting today's tax rate deduction. And later on, Uncle Sam's going to tell us when they want it back. It's changed from 70.5 to 72 to 73. In a few years, it'll be age 75. So they're constantly moving the needle on that. And then they have the ability at any time to change the tax rates, the interest rate, if you would, that we have to use to repay.
Wow.
So it's all based on legislation and the government as to how much tax we pay. So in my mind, it's kind of like a trap.
It is.
Well, I mean, our phones ring off the hook whenever we talk about taxes on the show. I mean, really, it's one of the number one issues I think people deal with as they're trying to figure out their retirement is how to be efficient there. And so we started really having a great relationship with a CPA in town to help with that. But how many times have you met with people or families that have accountants that you've kind of bounced ideas off of them based on their financial situation and come up with a great plan? Maybe not a completely tax-free plan, but something that was more efficient.
Oh, for sure. And that's really the key. Don't procrastinate. Don't put it off, but start today to put together a plan. And it starts with a tax map, Cynthia.
Yes.
Having your own personalized tax map so you can see the problem. Now we can start crafting a solution.
Most important, having that tax map. Well, Kristen, thank you for another amazing episode this week. Greg, thank you. To our viewers at home, if you would like to have your own tax map, don't miss the opportunity to call in today, 614-336-7660, or if you have your smartphone handy, go ahead, grab it, click on that QR code at the bottom corner of your screen. That will take you right to the landing page for Legacy Retirement Group, and you can schedule your time accordingly using Calendly. Be safe, be happy, and be blessed. We'll see you back 1 week from today. Thank you for watching Winning Retirement TV with Greg and Kristen Taylor.